Good day, ladies and gentlemen. Today I will be doing PEARS LTD. One of the questions in the question bank for MAC3761 out of 50 marks. And I will begin with analyzing the information. Then after I will look at the requirements. However, I might stop along the way after I've covered some information and say if that will pay back or not. PEARS Ltd is a Johannesburg Stock Exchange listed telecommunications group of companies. Currently, the group consists of division PEAR Mobile, which is DPM, and this is the name of the division. And this division produces PEAR Mobile, which is PM smartphones only, and the division PEAR Tablet, which is DPT, which produces PEAR Tablet only, which is PT in abbreviation, the second product that they are producing. In line with the latest technical trends, PEAR is also planning to extend its product offering to include smart watches, which will be DPM manufacturing plant in Polokwane, while DPM's manufacturing plant is in Polokwane, which is the first product, the smartphones only, while DPT, which is the one that produces tablets only, manufacturing plant is in Cape Town. And PEAR have 20 retail outlets across the country from which its products are sold to the public. The annual normal production capacity is 20,000 units of the PEAR Mobile and 12,000 of the PEAR Tablet. Remember, PEAR Mobile is produced in the PEAR Mobile division, and PEAR Tablet is produced in the PEAR Tablet division. Then these are their normal annual manufacturing capacity for the two products. 20,000 and 12,000 units, and it is an annual capacity or production capacity, not a monthly capacity. Both the production and the sales of units occur evenly throughout its financial year. That is very great to know. That means if we want to do maybe an income statement for 1 month, we just divide these units by 12, these units by 12, because productions happens evenly throughout the year. That means they produce equal units every month, which end up to the total of 20,000 and 12,000 for the entire year. Although the group makes use of an absorption costing system for external reporting purposes, it also uses the direct costing system for internal reporting purposes. So they are using both external reporting absorption and internal reporting, which is direct costing. Both of them, they have benefits or reasons why external must be absorption and why internal must be direct method. We'll get to hear all those two stories. Then after it further say that all types of inventory are valued using the first in, first out method, and the fixed manufacturing overheads are absorbed at a predetermined absorption rate based on the annual normal production capacity. So that means our POR is done or calculated using the normal annual production capacity. Then after we continue on that same note, which means we'll be using our normal annual capacity to calculate our budgeted fixed manufacturing overheads, which is our POR. Then we need to compare that with the actual to determine if we have the over or under applied recovery rate. The resulting over or under recovery rate is treated as a period cost. The minute the over or under is treated as a period cost, that means it should not be included in the calculation of the cost of sales, either by plus or by minus. You'll see that when we are required to do the income statement, because the minute they also bring this across, meaning there's a likelihood that will be required to do the income statement. Then after, we need to effect the over or the under manufacturing overhead. PEARS cost of capital rate is prime linked at 5% below the prime lending rate. The target annual return on investment is 11% for the division of the PEAR mobile, and 11.5 for the division of the PEAR tablets, which is the tablet and the smartphone division. They have two different returns on investment. And we also do have the cost of capital, which is 5% below the prime lending rate. That means later on we are expected to be given the prime lending rate. Then in that prime lending rate, we need to decrease it by 0.5% in order for us to get to our cost of capital. And the cost of capital is used when we are calculating the residual income. When we're calculating our residual income, remember we say controllable profit minus the cost of capital charged. And the cost of capital charged, it is the controllable investment, multiply that by the cost of capital. So we'll deal with that if they do give us all of that. The returns on investment can be used when we're calculating our EOQ. When we calculate EOQ, the return on investment is multiplied with the price, the purchase price of that product, which is below the division under your EOQ formula. Remember, your EOQ goes like this. It says 2 times the annual demand U times by ordering cost, divide by H plus the price times by interest. So the price here is multiplied by the return on investment, depending on which of the two are you dealing with. So that is where that return on investment is used, if the EOQ is part of the requirements. Or else the return on investment will be used when we are comparing the target return on investment with the actual return on investment, to determine either the divisional manager deserves to get a bonus or a performance bonus or not. So we normally use the return on investment in such circumstances. You need to be very familiar in terms of what to use the figures or the amounts that you are given for, so that when the requirements comes, you already know what is required. Number 1 says the annual general meeting for the financial year ended 31st of August 2016. These resolutions or items were proposed with no objections. There were no objections at the AGM, which is the annual general meeting, which was held on the 30th of November 2016. Remember, this annual general meeting was for the year ended 31st of August 2016. So, and there were no objections that took place. Remember, the year ended 31st August 2016, then we had September, October, November. So the AGM took place 3 months after the end of the accounting period. So now it was the report on what had happened up to the year ended 31st of August. Then 3 months down the line, the AGM was held to give the report on the performance of the organization. Number 1.1 says, Head Office will pay each division a performance bonus equal to 1.75% of their respective actual 2017 financial year sales figure, only if such a division meet or exceed its target return on investment. Now we can see from this point that we have to calculate the actual return on investment. Then I will check if the actual return on investment for each of these divisions, is it equal or more than the 11%, or is it equal or more than the 11.5%. If it is equal or more than these target returns on investment for each of the required divisions, therefore now that divisional manager will be entitled to 1.75% as a performance bonus from the financial year end sales figure. So now that is how this company decides to give bonus to the managers. So now we can note that we can see that this target return on investment will be used in the calculation or in the comparison of the actual and the target returns on investment. Obviously, for us to calculate the actual return on investment, we need to know that we will calculate our normally will be given sales or a profit after certain expenses have been taken into account. Then after we check which expenses are controlled by the divisional manager, we look at the controllable cost and controllable incomes. Then we add all the controllable incomes and deduct all the controllable expenses and remove expenses that the divisional manager has no control over them, because the divisional manager's performance is not supposed to be evaluated on the cost that it does not have control over them. So just an overview of the thing that I'll be talking about as we progress. Number 1.2 says that the values of inventory items as at 31st of August 2016. Remember, 31st of August 2016, it is the end of the year. So now at the end of this year, we had the inventory values at the end of that year. We are provided with the two products, which are the product items that we have, and the units that were left at the end of that accounting period, which then obviously becomes the opening balance for the 2017 accounting period. And remember, 2017 accounting period, it is the period where these divisional managers will be given a return on investment if they meet or they exceed their target return. So now 2016 was the end of the year. Now the focus is on the 2017, but the closing balances of the 2016 become the opening balances of the 2017 accounting period. Now we are provided with the total value of the inventory. All these two inventories, meaning if we say 2,475,000 divided by 550 units, this will give us the cost of the opening inventory. How much did it cost us to produce one unit in the previous accounting period? 2,475,000 rands divided by 550 will give us the cost of 4,500, meaning it costed this company 4.5 to produce one unit of the PEARS mobile smartphones. Then divide here by 1,200. Then we see we have 9 million. 9 million divided by 1,200. The cost 9 million divided by 1,200 will give us the cost of producing one tablet from the previous accounting period, which was 7,500, which is the production cost, not the selling price. Now let me write this on my notes so that we have it drafted down for further calculations. So now we are under 1.2, I think it was 1.2. Yes, under 1.2, calculating cost per unit, 1.2. Then we're calculating our cost per unit for each of these products. We have per mobile and we have per tablet. Then our cost per unit will be 2,475,000 divided by 550. Another one is 9 million divided by 1,200. Then this one gave us 4,500 of the cost per unit, and this became 7,500 to produce this product per unit. We are extracting this from the provided information. We don't know if that will be needed or not. Then after it says under 1.3 that with reference to the inventory valuation as at 31st of December 2016, which is in reference to this one, 70% of the total manufacturing cost of each product are variable in nature, and the balance therefore is absorbed fixed manufacturing overheads, meaning 30% is our predetermined overhead rate, which is our POR, the fixed part of the fixed manufacturing overheads. So now let us calculate the 70% in this case, where they tell us that 70% is variable and 30% is fixed, which is absorption rate. 1.3 is where we are. Then after, let us calculate let us say the total cost. I want to divide the total cost here into fixed and variable. Then we have our variable cost for per mobile and per tablet. The variable aspect will be calculated from the 4,500 times by 70%. Let us do that calculation. 4,500 times by 0.7. It gives us 3,150. 3,150. Then for the tablet, the cost of the tablet is 7.5. For 70% of that is fixed. Then we say 7,500, 70% is variable. Then the variable aspect of this will be 5,250. Then we go to the fixed cost, which is the absorption rate. And again, we say out of the 4,500 of the cost of the per mobile, we multiply this by 0.3, which is 30%. It will give us the variable aspect. 4,500 times by 0.3. This gives us 1,350. Then for the tablet, which costed us 7.5, 30% of this cost of the tablet is fixed. Then 7,500 times by 0.5. This gives us 2,250. Then this is our allocated fixed and variable cost from the opening balances or opening cost of 4.5 and 7.5. Now I think I can say the direction of splitting this cost and why they gave us like that in the opening. Then now we go to 1.4. 1.4 says the appointment of DINATLA auditors, which is RASA, as the group external auditors. The divisional manager have no influence or they have no control over the appointment, including the fee negotiation of the external auditors. Now, what does that mean? That means under 1.4, we need to be very specific that 1.4, divisional managers, I don't want to write, it will take more time. But under 1.4, it means we are not going to include the audit fees and or the audit cost that will be allocated to each division. Why? Because divisional managers have no influence or control on the appointment of the external auditors, and also including the negotiation of the fee of the auditors that will be allocated to each department. But it will be the head office that does that. So the minute the divisional managers have no control over that, then the audit fee should not be included in the calculation or in the calculation of the target return on investment, so on the return calculation on investment or calculating controllable profit. Now under 1.1 it says, and 1.5 it says, launch of the smart watches, which is per watch during 2018 financial year. Then now we then 1.5 it is the launch, but there's no further information. Maybe they will provide with us later on. And it says during 2018 financial year. We are still busy with the 2017 financial year from 2016 to 2017. So 2018 is likely to be provided later on. Then now under number 2 it says the actual annual units produced, which is, this is now the actual results that we are under. We are dealing with the actual results. That is our number 2, actual results. Actual 2017 results that we are busy with now. It further says that the actual annual units produced were 85% and 90% of the annual normal production capacity for per mobile and the per tablet. So now 2.1, we look at the production. 2.1, we look at the units produced. And the units produced for per mobile will be 20,000 of the annual capacity times by 85%. Then for the per tablet, annual normal capacity is 12,000 times by 0.90, which is 90% of that. Then 20,000 times by 0.85, that is 17,000 units. So these are the units that were actually produced in 2017. Then 12,000, we produced 90% of that as the actual production, which is 10,800. Now remember, we do have opening units. Now we have production. We must look for another one so that we are able to complete the missing units. 2.2, they tell us how many units were sold. They say under 2.2 that 16,800 units of per mobile and 11,000 units of per tablet were sold at 7,400. That's what we're talking about. And 9,800, this is in reference to the second product. So we do know how many units were sold, and we also do know how many units were produced, and we do know how many units were there at the beginning of the period. So now what is left is the units that are left at the end of the accounting period, which is closing inventory. Now let us calculate the 2017 closing inventory. Hoping there will be enough space. It will be there will be no space enough here. 1, 2, 3, 4. That won't be enough. Then now we are under 2.2. Calculating the units that are left. 2.2. We're calculating closing inventory. Closing stock, we have per mobile. We also have per tablet. We have opening inventory. Our opening inventory is 550. Then here we have 1,200. Then we have production units that were produced. Production we have calculated it to be 17,000 and 10,800. The one that we just calculated now, units that were produced during 2017. Then after we go to the sales, they told us how many units were sold. It was 16,800, and here it was 11,000 units. Let us just verify that the sales are provided under 2.2, given 16,800 units that were sold and 11,000 units that were sold. The selling price is 7.2 and 9,800. Now we are just looking at the units that were sold. Therefore, now this will give us closing inventory. This will give us closing stock. And our closing stock in this case for each of the product, it will be 550 plus 17,000 minus 16,800. This gives us 750 units that are left at the end of the year. For the mobile phone, 1.2 plus 10,800 minus 11,000. That gives us 1,000 units that are left at the end of the year. So that was 2.2. Remember, 2.2 were only provided with the units sold, but because we know that at the beginning of the year we had our opening stock, and during the year we know that was during the year production, and now when they give us sales, we know that what will be left will be the closing inventory. Now you should be able to link the information. 2.3 says the unit variable manufacturing cost increased by 6% for each product, whereas the fixed manufacturing overhead absorption rate increased by 2%. Now remember, the cost that we have per unit, which was calculated and also divided into fixed and variable, it was for the 2016 financial year. This was for 2016. Then we are beginning 2017. Here they're telling us that the cost which was variable and fixed increased by 6%, which is the variable one. Let me just use a different color. They are telling us that this cost increased by 6%, which is the variable aspect of the cost from 2016. And this also increased by 6%. This only increased by 2%, and this increased by 2%. Then this increase was for 2017. So, meaning now the actual cost of 2016 was used as a base of calculating the cost for 2017. We just increase all of that by the respective percentage, the 2% and the 6%. Now let us calculate the cost per unit for the year 2017. Cost per unit for the year 2017, that is under 2.3, calculating cost per unit. Under 2.3, we are calculating our cost per unit. Cost per unit. We have two products, which is the PEARS mobile and the PEARS tablet. We have the variable cost, variable manufacturing overhead. Now we know that we had the variable, which was 3,150 times by 1.06. Then the second one was 5,250 times by 1.06, increasing the variable portion of the PEARS mobile by 6% and increasing the variable portion, which was 70% when it comes to the PEARS mobile also. Then we're increasing this one 5,250 by 6% also. So now let us continue with that. 3,150 times by 1.06. This gives us 3,339. That was our cost per unit of the year 2017 of the variable aspect of the cost of this product. 5,250 times by 1.06. It gives us the cost of 5,565. Then we must increase our fixed cost, which is the fixed absorption rate, and the fixed cost per unit of the variable and sort of the PEARS mobile was 1,350. 1,350 times 1.02. The fixed part of the other product, 2,250. Then we increase that one also by 2%, which is the PEARS tablet, 2,250, 1.02. Then after we do the calculation, 1,350 times 1.02, and this gives us 1,377. Another one is 2,250 times 1.02. This gives us 2,295. If you want, you can write this one here and write this one here. I just prefer to put them in the same line. Then now we have to calculate the cost per unit, 2,295 plus 5,565. It gives us 7,860. Then 3,393 plus 1,377. It gives us 4,716 as the cost of this product for the year 2017. The cost of these two products for the year 2017. Then we have our cost per unit for 2017. For 2016, we calculated 4.5 and 7.5. For 2017, we're 4,716 and 7,860. So now let us stop in there and we just draw the line, show the division in between. Then we move to 2.4 and see what 2.4 has in store for us. 2.4 says that the actual variable selling cost per unit is 12 Rand per unit and 14 Rand per unit of a per mobile and a per tablet respectively. So now they give us other variable costs that are non-production related, which will appear in the income statement if that will be required, or will be used in the calculation of the contribution if contribution will be required. Then it says the actual fixed selling cost amounted to 980,000 rands for per mobile and 420,000 for the per tablet. Now when we are to do the break-even point, we will need this fixed cost and add other fixed costs that will be necessary or that will be provided to us. 2.5 say that PEARS was found guilty. Remember 2.4, there is nothing to analyze. All the information is provided in there as is. 2.4, we'll just use it when necessary. We just need to know that one of the costs is a variable cost, one of them is a fixed selling cost. PEARS was found guilty of price fixing and fined 80 million rands by the Competition Commission of South Africa. The allocation of fine to this division is approved by the head office. That means the divisional managers have no control over this cost. PEARS is only be liable for 50% of the fine imposed, while its board of directors are personally and severally liable for the other 50%. The head office paid PEARS allocated portion of the fine, which is the 50% being 40 million, and then liable for the other 50%, and then apportioned this amount in the ratio of 60% is to 40% to the per mobile division and 40% to the per tablet division. Now, for those that still remember financial accounting 2 or financial accounting 3 or financial reporting 3761 or 3701, they will know that a fine is a permanent difference and is non-deductible. So now, because a fine is a non-deductible expense, therefore now it is not supposed to be allocated to the divisional managers. And now remember, this will appear under the permanent differences when you do deferred tax. Doing deferred tax using the statement of comprehensive income approach, the fine, either is a traffic fine or a fine of this nature, it is a non-deductible expense and it is a permanent difference or non-temporal difference, either way you call it. So now this fine is not supposed to be appearing either in the income statement for tax purposes. So now the company was fined 50% and paid the 50%, which is 40 million. And this 40 million was allocated to the two divisions, of which 60% went to one division and 40% went to the other division. Although this has been allocated, it is non-deductible expense. Now that it is allocated to the divisional managers who have no control over this expense and did not cause this expense, therefore now this expense must be removed when we are calculating the return on investment or when we are calculating the controllable profit, because the divisional managers have no control over this expense. Remember, this expense will still be recorded because the company has paid for it and allocated in the income statements or in the profit statement of each division. So we'll deal with that when we are calculating the controllable income for this division. Now, number 2.6 says the actual legal fees paid by PEAR in relation to the CC matter, which is the above matter C2.5, was 7.5 million. So there were legal fees that were paid for this fine. And remember, this is a non-deductible, and now there are legal fees which will also be non-deductible. The head office allocated the legal fees equally between the divisions. And as a policy of the group, all PEAR legal matters, including related legal fees, are sole responsibility of the head office. Now that means the legal matters, the legal fees, and the legal cost are the head office controllable expenses. They are not controlled by the divisional managers, all of them. So the minute the divisional manager has no control over the cost, or has no influence over the cost, that means that cost must not be included in the calculation of the performance of the divisional manager. So now again, the legal fee, which is allocated equally, remember equally means divide by 2, which is allocated equally between the division, will or is not supposed to be included when you're calculating the performance of the divisional manager or their return on investment or controllable profit. Now 2.7 says the head office allocated 250,000 audit fees. Remember, under 2 point something, I'm not sure if under 1 point something, we were told that the head office is the one that is in charge of appointing the auditors. And then during the negotiation, the divisional managers are not involved. They have no control and have no influence of the negotiation of the fee, meaning that was the head office job. Now here we end up now having the cost of that audit, which is 250,000 audit fee allocated to each of the two divisions for the annual external audit by the Denalta auditors, which are the auditors appointed in the previous year. So now this 250 again is not supposed to be included in the calculation of the divisional performance of the manager, because the manager has no control or influence over this cost except the head office. Controllable investment by 31st of August 2017 were 350 million and 220 million for both of the divisions respectively, and the South African Reserve Bank governed, which is Mr. Leseja, or governor, which is Mr. Leseja, announced the adjustments to the prime lending rate from 10.5% per annum to 10.5% per annum, effective from the 18th of March 2016, and the prime lending rate remained unchanged subsequently. So now we do have what we call the cost of capital. The cost of capital, because the cost of capital was said to be 0.5% lower than the prime lending rate, meaning our cost of capital will be 10% in this case. So our cost of capital will be 10%. Remember, when we are calculating the residual income, we say controllable investment times by the cost of capital. So this 10% will be multiplied by one of the controllable investment, so that we get to the cost of capital charged, which will be deducted from your controllable investment in order for you to get to the residual income. So now we need this 10%. We can do that under 2.9. Others, it was not necessary to do any allocation. But note this figure, and note this figure, and note also this one, because they are very crucial in our calculations. And also this one when it comes to the evaluation of the performance of the divisional manager. Now, we have the next information, which is for the 2018 now. This is the budget. We got to the actual information for 2017. This is actual for 2017. Now, under number 3, we have budgeted information for 2018 financial year. Now, let us wait in there, because we come from 2016 to 2017 actual. Then now 2018 budget, we must wait and answer all the questions for 2017. Then anything that has to do with the 2018 financial year budget, we wait for that. We only deal with number 1 and number 2 now. Then let us go to the first requirement. First requirement says calculate the actual closing inventory as at 31st of August 2017 by completing the table. We have already calculated the closing inventory as at 31st August 2017. Let me show you that. This is the closing inventory. This is the closing inventory for per tablet and for per mobile. So now this one is done and dusted. I'm not going to be rewriting that one. Obviously, when you're answering, you just copy the numbers as they are. We do have the sales in there, which was 16,800, 11,000 with the amount of sales. Closing inventory, 31st of August, we don't know that one, but we will know the opening was 550, the opening was 1,200 units that were produced, 17,000, and it was 11,000. It was 10,800 units that were produced here. Then after, the total of the two will give us units that were required. Total of the two will give us units that were required. Then after we minus our sales, deducting your sales, this will give you closing inventory as 750 and as 1,000. So please do calculate the addition. 550 plus 17,000 and 1.2 plus 10,800 will give you the units that were required. I do not have this line in my calculation. Now number B is the theory aspect, which I mentioned before. Number B is the theory aspect I spoke about before. Number B says, or asks if we should briefly discuss the 4 reasons as to why PEARS uses an absorption costing system for external reporting, but also use the direct costing system for internal reporting purposes. So that is the question: why are they using the two, and what are the benefits of each of the two units, the systems? In fact, the first one is the fact that as a Johannesburg listed company, PEARS is required to prepare and present its annual financial statement in terms of the International Financial Reporting Standard, which requires that inventory should be valued using inventory system. That is the first one. It's a JSE listed company, and it is the requirement of the International Financial Reporting Standard that financial statements should be in alignment with the International Financial Reporting Standard for inventory evaluation, which is absorption method in this case. Then the second one is to why they're using absorption is the fact that absorption costing system is help us in making useful decision regarding the financial statements. Remember, when I am an investor and I want to invest in a company, I want to make a decision, and a useful decision. So financial statements should include all the cost, and of which absorption costing include the fixed cost in the calculation of the cost of the product. So the third one, which is the direct method one, is the fact that the variable costing system allow us to calculate, or the variable costing system help us to know how much will be, how much the contribution or the amount that contribute to fixed cost. The variable costing, it reflects how much is each product contributes to cover fixed cost. When you say the variable costing help us to calculate or to know how much is the contribution to cover fixed cost, remember it says selling price minus variable cost. The amount that you get by doing this, let us say you get 10 rand, this will tell you how much each product will cover fixed cost, meaning for every product we sell, 10 rand, which is the contribution, will cover fixed cost. That means when the total of the contribution is equal to the fixed cost, the company is at the break-even point. So the direct, the variable costing method will help us, or it will be useful to help us reflect on how much each product cover fixed cost through the contribution. And secondly, the reason why variable costing method or direct method will be used is because divisional managers or management will need management accounts to make weekly decision, monthly division, monthly decision, quarterly decision, half-yearly decision, and that will be through the use of the direct costing. So such information will be from the direct costing system when decisions must be made on a weekly basis because things are changing. Remember, under the absorption, fixed costs, they don't change. So in the direct costing method, we get the flexibility of the information for taking decision on a weekly basis, monthly, quarterly, or half-yearly. So now such management accounts will be available using the direct costing method. So those will be the 4 points. Please look at that theory, just very straightforward. Number C, we are required to prepare the actual income statement for 2017. Now it is very easier to do this income statement for 2017 because we do have all the figure that we need for this income statement. Then now we are doing the 2017 income statement. What is this now? I think from the previous recording. I just probably forgot to erase it. Then now we are doing the income statement. This is number C. Income statement. We are doing income statement for which product, to be specific, for the PEARS mobile division only. For the PEARS mobile division only. Remember, at this point in time, we add all the cost. Even the costs that are allocated by the head office, they must be taken into account here. We are not evaluating the performance of the divisional manager. I want to make that one clear. We are not evaluating the performance of the divisional manager here. We are just calculating the income statement, and all the costs that are allocated to that division by the head office must be taken into account. Even those costs that the manager have no control over, they must be included because we are calculating the income statement looking at the overall performance of the division and not the performance of the divisional manager. Then now we go straight to that income statement. We have our sales. Our sales for the PEARS mobile were 16,800 at 7,200 rands. Let us just verify those sales. 16,000. Yes, 16,000. I wonder how did I not put the one. 16,800, and the price was 7,200 per mobile division. And take note of the fact that we are using absorption costing, and ignore the possibilities of the performance bonus. Thank you. I forgot to read that one. We must ignore the possibilities of the performance bonus because we are not evaluating the performance of the divisional manager. Not at this point in time. Now we are looking for the selling prices for this product. Selling prices were provided as 7,200 for the PEARS tablet and 9,800 for the PEARS mobile. So I was correct with the calculations in there. Then we have 16,800 units at 7,200, and this gives us 120,960,000 rands. Then we have cost of sales. Now, under our cost of sales, we need to be aware of the fact that there is opening inventory, and our opening stock was worth an amount of 2,475,000. It was provided to us. Then we have our production, the number of units that were produced. Our production was 17,000 units. Then we need to multiply the production by the cost per unit. cost per unit, it was under 2.3. We calculated the cost per unit. We are in 2017 now, which was increased by 6%, 6%, 2%, 2%. 4,716, 4,716. Then we say 4,716 times by 17,000 units that were produced. It gives us a total of 80 million 172,000. 80 million 172,000. That will be the cost of production. Then we need to deduct the closing stock. Our closing stock was 750 units, and the units that were left for the PEAR Mobile, which is produced under the PEAR Mobile division, 750. The cost of these units is the cost of 2017, not the cost of the previous year. So now it will be multiplied by the cost of 4,716. Then after we have 750 times by 4,716. Then we get to 357 or 3,537,000. Then we have 3,537,000. I decided to keep this negative, then this will be positive. If it was the other way around, you still do the same thing. This can be positive, and this is negative. Then we can now be able to calculate what we call the cost of sales. Now, the cost of sales do not include the over or the under applied manufacturing overheads. They don't include it because it is treated as a period cost. That is why your over or your under will not affect your cost of sales, because it is treated as a period cost. Then we say minus 80,172,000 minus 2,475,000. Then now this gives us the amount of the cost of sales as 79,110,000. 79,110,000. But we don't deduct the 2 and say 120,960,000. No, we don't deduct the 2. Then we get to the gross profit. No, we first need to adjust now. Make the adjustment of the fixed overhead over or under recovery rate. Then we don't know either it will be plus or minus. Let me just say plus or minus. Fixed overhead recovery rate. Fixed overhead. Fixed manufacturing overhead recovery rate. Recovery. It might be over or under. Then I will say that one when we do the calculations. Now let us look at the calculations of this amount. Let us look at the calculation of this amount. Remember, we were told that this calculation is based it is based on the budgeted units. It is based on the budgeted units. Now let us then do that calculation. We know that our budgeted units, let me just do the calculation in here. No, this will disappear. Our budgeted units, we had 20,000 for this product. And this 20,000, we have to multiply the 20,000 by the total, by the cost of the recovery rate, the recovery cost, or the fixed overhead cost per unit. Now we were told that, let me just align this with what is provided. We were told that, just want to make sure that we are on the same page. Therefore, the absorption rate, there's a part that made this very clear. It's not this one. 70% total manufacturing overhead costs are valued nature. Okay, it was in the beginning. there's a part that, okay, this one, the resulting over or under, not this one. Yes, fixed overheads are absorbed at the predetermined absorption rate based on the annual normal production capacity. So now that is the base to calculate our predetermined overhead rate based on the annual normal production capacity. So that is the sentence I wanted to align my explanation now with. So now we know that we are focusing only under per mobile cell phone, and the fixed overhead rate for 2017 was 1,377, and it's based on the normal annual manufacturing capacity. So now we need to say 20,000 multiply this by 1,377, and we see how much do we get. We say 20,000 was our annual normal capacity times 1,377. This gives us 27,540,000. Then now we need to go to the actual figures. We need to go to the actual fixed overhead. This was based on the budgeted annual normal capacity. In actual fact, we produced 17,000 units. That was our actual production. Then we need to say our actual production times by our POR, 1,377. Then we see how much the difference. We say 17,000 units times by 1,377, which is our POR. This gives us 2,340,000, 9,000. 23,409,000. 23,409,000. Then we deduct the 2 minus 27,540,000. 540,000. Then the difference now of our recovery rate is 4,131,000. 4,131,000. Now remember, in our income statement, what do we have? We have this 23,409,000, of which budgeted was 27 million. But in actual fact, we have 23,409,000. So now that is the amount that we need to make an adjustment with. And you can see that 27,540,000 and 23,409,000 in this case is really understated. So now that will be under. That will be under because this is what has actually taken place. Then we go and record that difference. 4,131,000. 4,131,000. And now once again, this amount must not appear in our income statement. This amount must not appear in our income. Sorry, this amount must not affect our cost of sales. It must appear but not affect our cost of sales, because it is treated as a period cost. Then now let us calculate our gross profit. Then we calculate our gross profit. It only affects the gross profit, not the cost of sales. Then now we will have to say 120,960,000 minus 79,110,000 equals, initially you see that we get 41,850,000. We get 41,850,000. Therefore now we need to make an adjustment of this because of the under recovery. We must make an adjustment of this. Then we say minus 4,131,000. We get to 3,770,000. or 37,719,000. 37,719,000. 37,719,000. Then we got to our gross profit. That is our gross profit. Now we continue on that same note. We go now to the other expenses. We have our selling cost that should be deducted. Then we have other expenses to be deducted. Let us deduct first the selling cost. If you remember, we had our selling cost. Our selling and administration costs, which were provided to be 12 Rand per unit, if I still remember. We had the selling cost of 12 Rand per unit. Yes, selling cost was 12 Rand per unit, and the fixed one was 980,000. 980,000 is the fixed for the per mobile division. 12 Rand is per unit. So let us look at the variable aspect, which is 12 Rand. For every unit that we sell, 12 Rand times by 16,800. 12 times by 16,800. We get 201,600. Then we, how is this complete now? Okay. Then we get fixed, and the fixed one is 980,000. Very straightforward. Then after we have other costs, that must be taken into account, or other expenses. Other expenses, we had a fine which was non-deductible, and after that fine we have audit fees and legal fees. Then we have legal fees. We could start with the legal fees or the audit fees. We know that there was a total of 80 million. 80 million, of which the company was only liable for 50% of that, which is 40 million. And that 40 million was allocated in the ratio of 60:40. 60 was for this division. So this is 2 million, or this is 24 million. This is 24 million that was allocated in this division, because it was 60%. Then the rest out of that 40 million, which is 60 million, was for another division. The audit fees were 250,000, if you remember that one. Sorry, I do keep the numbers in my head. The legal fees were 75 million, and half of that was allocated. Divide by 2, that is 37,500,000. These were the costs. You can just verify in case you forgot. This one is 980. We talked about that one. We had the 80 million, of which only 50% was the company liable. 60% of that 50%, meaning 60% of 40 million, was allocated to this division, and 40% of that division. 75 million was the legal fees that was allocated equally, and 250,000 for each of the two divisions. So that is where all these costs are coming from. Now we can add all these costs, can add and have the total in there, and have the total in there for each of them separately. Then let us check. Plus 250,000 plus 24 million, it gives 61,750,000. 61,750,000. Then we have 201,600,000 plus 980,000. That is 11 million. That is 1,181,600. 1,181,600. We add that with the 61,750,000. We deduct 37,719,000. Hope that is correct. Let me just verify. We have 11, and we have, let me check, 24 million plus 250,000 plus 3 million. This is 3,750,000. How much was this cost? This was 7.5 million or 7.5 million, so I just overstated it, meaning this will be 3,750,000. Then this figure is too much overstated. Then that means we get to 3,750,000. That gives us a different figure. Let us say 3,750,000 plus 250,000 plus 24 million. So that is 2 million or 28 million. 28 million plus 1,181,600 minus 37,719,000. Then we get to 853,000 or 8,537,400. 8,537,400. This will be our profit before tax. Profit before tax. Now, when it comes to this question, there's still a lot to be done. When SARS is calculating tax, or when tax is calculated, all these will be permanent differences. A fine will be a permanent difference, and it will be a non-deductible expense. So we will make adjustment there when it comes to deferred tax. When you do a deferred tax, this will be adjusted. Now, moving forward to the next requirement. It says that based on the results, now we are going to 2017. Only 2 questions left after this one. Based on the actual results, assume that the actual profit before tax and the performance bonus for the financial year end 31st August 2017 is 18,520,000 for the DPM division and 7.8 million for the DPT division, which is the one that produces tablet. Calculate the residual income for the tablet division for the financial year end at 31st August 2017. Then for the same tablet division, we are to calculate the target, the performance bonus, if any, that the head office will pay to the divisional manager at the end of this year. Now, we are focusing now only to the tablet division, where 7.8 million was the profit that was made. And the profit is after all the expenses were taken into account, which is actual profit before tax, similar to what I've just calculated, or the same as I calculated. Now we need to remove expenses that are not supposed to be there in the calculation of the performance of the divisional manager's performance, and also residual income and controllable income. Now, we are looking at this number D. Then we start with the profit before tax. We start with the profit before tax. And our profit before tax is 7.8 million. 7,800,000. Then we need to add back non-controllable expenses. Add back non-controllable expenses. Non-controllable expenses. Non-controllable expenses, 7,800,000. Let us look at the first one. The first one is the fine. The fine that was allocated to this division. Remember, it was 40 million. 40% was allocated here. So it is 16 million. Another one is the audit fees or the legal fees. Let us start with the legal fees. The fine is from the Competition Commission of South Africa. The legal fees were 3,750,000. Remember, it was 7.5 million. 3,750,000, it was 50-50. 7,500,000 divided by 2. Then we have audit fees. Remember, the divisional manager has no control of this cost. The audit fees, were told that the head office allocated 250,000 to each of the divisions. And so these are the costs that the divisional managers has no control over, and they are controlled by the head office, or the divisional managers have no influence over. So now we had to add them back because they were deducted in the calculation of the profit before tax. So now for us to remove a cost, we needed to add it back. So we have 16 million plus 3,750,000 plus 250,000 equals 20 million exactly. Minus 7 million, 16 million 37 800. This gives us, let us just verify, 7,800,000. Just verify. I don't know why these figures, I don't get them very correct. We have 7,800,000. That is correct. Now we have 16 million, which I am fine with that. 16 million, because it was 40 million, 40% allocated in that 40 million. Then 250,000, no problem, I'm fine with that, and 3,750,000. Then now, oh, sorry. Then I see what I'm doing. This is add back, not deduct. I'm wanting to deduct now. 7.8 million plus 20 million. I'm adding them back, then it will give me 27,800,000. This is the so-called controllable profit. Please know that we are adding this cost because they were deducted and they were not supposed to be deducted. Then we need to add cost of capital charged, or deduct less cost of capital charged. Cost of capital charge. What is cost of capital charge? Cost of capital charge is the controllable profit times by the cost of capital. Our cost of capital, we know that it is 10%. Our controllable investment under 2.8, it is 2,220,000 times by 10%. 10% was 10.5 minus 0.5%, because we're told that the cost of capital is lower by 0.5% from the prime lending rate. Official prime lending rate, it is 10.5. So we deduct 0.5, meaning the cost of capital then becomes 10%. Then we have 220 million times by 0.10. 220 times 0.10. This gives us 2,200,000. This gives us 2,200,000 minus 27,800,000. Then the profit, the residual income then becomes 58 or 510 or 58 million or 5,800,000, not 58 million, 5,800,000. Then this is our residual income. Now that the residual income is complete, then we need to calculate the target return on investment now. Calculating the actual return on investment. How much is the return on investment, which is our ROI. Return on investment is controllable profit divided by controllable investment. Our controllable profit is 27,800,000 divided by controllable profit. Controllable profit divided by controllable investment. Then we need to multiply this by 100. Then we do the calculation. 27,800,000 divided by 220 million. Multiply this by 100. We get, not in the rands, we get 12.63636, which is equivalent to 12.64%. Then we had our target return on investment. Return on investment for this division, which was, the target return on investment was 11.50%. It was 11.50%. Now we can see in this case that the divisional manager has performed above the target by 1.14%. Above by 1.1%. So the divisional manager, in conclusion, will qualify. The bonus required. Then let us calculate the bonus. Bonus amount. Bonus amount is equal to how much are the sales. Now we need to look at the sales for this division specifically. The sales of this division, we had 9,200 times by 10,800. no, this was the production, times by 11,000. Then times by 1.75%. We'll see how much will be the bonus amount. 9,800. Let us just verify if it was 9.2 or 9. I think it was 9.8. The selling price. Yes, 9.8. That was the selling price for the tablet. So it is 9,800 to calculate the amount of sales, times by 11,000 that were units that were sold. Then we multiply this by 1.75, divide by 100. It gives us 180. 1,886,500. 1,886,500. So this is the bonus amount that the divisional manager will get for the performance of this year. So in conclusion, bonus requirements, the divisional manager meets or exceeds the target return on investment by 1.14%. From 11.50, we got 12.64. Therefore, now the bonus amount will be this amount. Just conclusion in short. Then now let us go to the next requirement. We are moving a little bit faster than I anticipated. Let us see where the next requirement bringing us. Remember, this was calculating the the residual income. We did that one. Then this was Roman figure 2 to check if does it deserve to get a bonus. Yes, we said yes because it got 12.64 and exceeded the target return investment. Therefore, now the bonus amount will be 1,886,500. That we have responded to both of them. Now we are in the 2018 budget information results. We are then required now to do two things in here. The margin of safety is the requirement. The second one, optimum number of units, meaning now we'll be dealing here with the limiting factor. Then after we are done, the last two is just the non-financial measures, listing only 4 of them. So we are focusing on number E and number F. Then after we're done and dusted, let us analyze the 2018 financial budget. Then we come and respond to the margin of safety for each of the 3 products for the financial year. For 3 of them, we do margin of safety. The margin of safety is specified. If it's in units, they do not specify. Calculate the budget margin of safety or percentage. They specify percentage for each of the 3 products. And after, the optimum production mix. Number 3 is where we are. Number 3 is where we are now. Then let us do budgeted information for 2018 financial year. The following are an extract of the group approved budget for the 2018 financial year. 3.1 says the demand and sales units for PM and PT are expected to be 18,000 and 12,000. So this is their planned demand, which is production and sales. They plan to produce and sell everything. The launch of the smartwatches, it says that PEARS will take over Domlex Pty Ltd, a struggling but promising smartwatch production company. From Nelspruit, now they're introducing another location. Previously, it was Cape Town and Johannesburg, their main production for each of the 2 products they had previously. I think it was Polokwane. Another one was in Cape Town. Then now there is a Nelspruit one which produced the smartwatches. Then it further says that continue. Domlex will be converted into a new division. Now they're introducing a 3rd division, which is division PEARS Watch DPW, to produce and sell unisex wrist smartwatches. PW is expected to start selling these watches from the 1st of March 2018. That's information they're giving us. Product testing time. Now the time to produce or the time to test the product. All of PEARS products are hand tested at the centralized warehouse in Johannesburg before they are made available for sale. PEARS testing capacity is based on its 7 permanent employees. So they have seven permanent employees. The clock hour and productive hour for each of these testers is 8 hours and 6 hours, 6.5 hours respectively. That means they clock for 8 hours, but they are only productive for 6.5 hours. So we have to look at this difference between the two. That is what is called the idle time. When we do the idle variance, then we deal with the idle time. Now, they are only productive 6.5 hours out of the hours that they are clocking or they are paid for. So now there is 7 of them and they work 8 hours. Each of them, they work 8 hours. And it further says that during the 240 working year, each tester is required to take 20 working days compulsory annual leave. And it takes one tester 15 minutes to test one product and 30 minutes to test PT and 12 minutes to test the PW. So we have the 3 times 3, 15 minutes for the mobile, 30 minutes for the tablet, and 12 minutes for the watch, unisex watch. Now we need to say this is the required time. These are the required times to produce the product that this company wants to produce. Remember, the 15 minutes is to test the whole of the 18,000 in there. And the 30 minutes is to test each of the 12,000. And the 12 minutes is to test for each of the 3,000 of the wrist watches, unisex watches that they want to produce. Sorry, I'm being forward now. It further says that additional product information, we have the demand, of which the demand here is question mark because they told us the demand, and here the demand is 12,000 units, and the demand for these watches is 3,000. And their cost per unit, we have the selling price, which is per unit 7,800, 10,400, which is selling price per unit, and 4,700. We can see that the prices are going up. Prices are going up year after year. The price of these tablets and cell phones are increasing, which is practically what is happening in the cell phone industry or in the digital industry. Variable manufacturing cost, we have this variable cost and variable selling cost. They gave us other variable cost. They don't tell us how much are the fixed costs per unit. Then after they tell us how much are the budgeted fixed cost in terms of manufacturing and budgeted fixed cost in terms of the selling cost. They gave us the total of the fixed cost. So now we can see why they need us to calculate the break-even point when we use the margin of safety. So now it will be easier for us because we already have the total of the costs that are fixed. We add them, then we divide by the contribution after the sales mix has been taken into account. Now let us just randomly calculate the contribution per unit. Selling price 7,800 minus 4,950 of the variable cost minus 14 rand of the variable selling cost. We can say that we get to 2,836 as the contribution. That means for every unit of PM product, this will contribute to cover fixed cost. It will reduce our fixed cost. Then now that means this will come and say deduct in here in the fixed cost. Up until the total of the sales of this units are equal to the break-even point, the fixed cost, we are not at the break-even point. That means when the contribution is equal to the fixed cost, when contribution equals fixed cost, the company is at the break-even point. That is why when we're calculating the break-even point, we say fixed cost divided by the contribution. Now the contribution is how much each product per unit is covering its fixed cost, or the total fixed cost. We go to the contribution for the second product. Selling price is 10,400 minus the variable manufacturing cost of 8,100 minus the variable selling cost of 16 rand, and this gives us 2,284 rands. The last product, it is 4,700 minus 3,200 of the variable cost minus 5 rand of the variable selling cost. That gives us 1,495. We need to look at what is called the sales mix. There was no talk about the sales mix. In this case now we need to say, okay, how many units are we planning to sell? These are the units that are expected to be sold. We need to know the ratio, in other words, the ratio of the sale of this product. We have 3,000 does fit to 3,000, and 3,000 does fit to 12,000 and leaves no remainder, and 3,000 does fit to 18,000 and leaves no remainder. So let us say 18,000 divided by 3,000. It gives us 6. That means our sales mix will be 6. Sales mix will be 6. For the second product, it will be 12,000 divided by 3,000. That gives us 4. So 6 is to 4 is to 1. For the last one, it will be 3,000 divided by 3,000. That will be 1. So now when we're calculating our average contribution, contribution after the sales mix, it will be, this will be 1 times that, it will give us the same 1,495. Here we have 2,284 times by 4. This gives us 9,136. The last one will be 2,836 times by 6. This is 2,836 times by 6. This is 17,000. I thought it's 1,000. 17,016. This is 17,016. Then we add all of them, plus 9,136 plus 1,495. This will be what we call the weighted average contribution. Then now we can calculate the so-called break-even point. Break-even point. You might be wondering, why, Mr. Mjongwana, are you calculating break-even point? It is because for us to calculate the margin of safety percentage, we need the units at the break-even point. That is the formula. The formula says expected sales minus break-even sales units. So break-even point is necessary in the calculation of the margin of safety percentage. So now we have to say break-even point is equal to fixed cost. Our fixed cost, total of the 3 will be 27,647. Our total fixed costs are 4,200,000 or 42 million plus 16,850,000. 16,850,000. That is 58,850,000 divided by 27,647. So our break-even point then becomes divide by 27,647. My calculator now. It does not. Okay, 27,647. Oh, there was something wrong in there. Then the break-even point the break-even point becomes 21.28, not in rands. It becomes 21.6215503, which then that is equivalent to 2129 units. 2129 units. Then we do now the break-even point for each product. They set for all the three products. Let me verify if that is true. A budgeted margin of safety for each of the three product types, for each of them. Now we know that the break-even point per batch is 21.29. Now let us do it for each product. Remember, we know that our sales mix is 6:4:1. 6:4:1. Now I want to do this on the separate side. Then with calculating break-even point units for PM, for PT, and for PW. It will be 2129 times by 6. It will be 2129 times by 4, and 2129 times by 1, which is 2129. Then 2129 times by 4, 8516. This is the break-even point for more than 1 unit. 2129 times by 6, it is 12,774. This is the break-even point in units. When you are required to calculate contribution at the break-even point, then you take this break-even point, you multiply it by contribution when you are required to calculate contribution at the break-even point, but we are not required in here. So now in that case, you'll take these units, you multiply them by the contribution, and the contributions will be those contributions. These are the figures of the contribution you calculated. Where are they? These are the contribution that we calculated. These are the figures for your contribution that you would have calculated. Remember, contribution, it is selling price less variable cost. We deducted the variable cost from the selling price. It gave us the contribution of these figures. Then after, we'll be multiplying that, but we are not required to do such. Now we must do the margin of safety. Margin of safety, percentage, margin of safety, for each product. Let me just think of the best way. Let us do the heading. Let us do the heading. It will be PM, PT, and PW. We say expected sales 18,000 minus sales at the break-even point 12,774 divide by expected sales 18,000 times by 100. Expected sales here are, I'm not sure if I do have the expected sales in here. Expected sales, I think 12,000. Yes, expected sales is 12,000. There, the 12,000, it was provided also above. Expected sales are 12,000 minus sales at the break-even point 8,516. How many units must be sold for us to be at the break-even point? Divide by expected sales times by 100. Then the last one is also expected sales at 3,000 minus sales at the break-even point 2,129. Divide by expected sales of 3,000. We multiply that by 100 also to get to the percentage. Then it will be minus 18,000 equals divide by 18,000 equals times by 100. We get to 29.03% for this one. The second one, it is 12,000 minus 8,516 equals divide by 12,000 times by 100. Margin of safety here is 29.03% also. The third one is 3,000 minus 2,129 equals divide by 3,000. Then we times by 100. It is 29.03. Now margin of safety is the safety position above the break-even point. Safety position above the break-even point. That means if our sales decrease by 1%, we'll still be making profit. 2% will still be making profit. But if our sales decrease by 29.03% above the break-even point, that means the company will be at the break-even point. And if sales decrease by 30%, then the company will start making a loss, meaning it is the safety percentage decrease in sales in excess above the break-even point. So we have responded to that requirement. Then now we go to the very second last requirement, which is the optimum number of products that can be available for sales based on the 31st August 2018 budget. And we could have seen that the labor hours in this case will be the limiting factor. We need to just check and verify if are the labor hours really the limiting factor. Now let us go and do that test. If labor hours are really the limiting factor. And please guys, just restructure this. Go to your answer sheet, calculate contribution for the trade division. You'll be copying the selling price less variable cost to copy the variable cost. Then you get your contribution. Then from your contribution, you calculate your sales mix separately. Show the calculation that you said this divide by. Then after that, you multiply your sales mix. Then when all that is done, you get the total of your contribution after the sales mix. Then after you take your total fixed cost, which is 58,850,000, divide that by the total of the total, which is 27,000. Then after that will give you the contribution per page. So do that in your workings. In this case, I just decided to do the workings in here. But now we are looking at the hours. We are now looking at the hours that are required, or looking at the available time compared with the required time. Remember, the required time is the 15 minutes, the 30 minutes, and the 12 minutes that are required for us. So let us continue on that same note. Let us first look at the time that is required. Let us look at the time that is required from the number of units that we want to produce, which is the expected production and sales, including the third one, and say how much time is required. Then let's do the required time. This is the very close last requirement. Required time for PM, for PT, and for PW. We want to produce 18,000 units, and each unit requires 15 minutes. Just converting, that one is already in my mind. 15 minutes divided by 60 minutes is 0.25 times by 18,000 units, because each unit requires this time. That means we need 4,500 hours. This is the time that we require to produce 18,000, which is the testing time that is required, because every product must be tested. We need to check if do we have enough capacity for testing. Here we are expecting to produce 12,000, and each unit requires 30 minutes. So we say 30 minutes divided by 60. Remember, I'm converting the minutes into equivalent time in hours. So you don't have to do that. If you want, you can operate with the minutes. For me, I just prefer to deal with the hours. So we require 6,000 hours. If you want, you could have said 18,000 units times by 15. That will give you 270,000 minutes. Of which 270,000 minutes is equal to 4,500 hours. So if you say 4,500 times by 60, that will give you 270,000 minutes. So either way, converting which side to get to the same numbers or the same decision. So we have 3,000 here, and this requires 12 minutes. Then 12 divided by 60 is 0.2. Times this by 0.2. Multiply this from 3,000. That means we require 600 hours, 600 testing hours. 600 testing hours. Then let us look at the total plus 6,000 plus 4,500. That means we require 11,100 hours. That is the required time. Now let us check the available time. How much time is available? The employees work 7 hours, and the 7 employees work 8 hours. Sorry, they clock 8 hours, but they are only productive for 6.5. We need to be very clear on that. We multiply by 6.5 because 6.5 is what is available productive time. The other one, which is 1.5, is unproductive. So meaning the time these employees are working, all 7 of them per day, 7 times by 6.5, meaning per day they work 45.5 hours. That is the productive testing time. And there is 240 days in a year, and these employees, they take 20 days of leave. So 20 times by 7, meaning 140 is not available. So that means 140 is the time that is not available because these employees, they are in their leave time. So that is why now in this case we need to deduct the 140. Then now remember, each employee, if we take the 140, then we need to make sure that we say 240 times by 7 because each employee is entitled to the same 240. Then we can say 240 times by 7 minus 140. Or else if we don't multiply by 7, then we need to say minus 20. Then if we deduct by 20, that will still be okay. That will still be okay. I don't have a problem with that. So let me use this approach because I've already multiplied by 7 employees in here. Then I will say the time that is available out of the 240 minus 20, meaning these employees only work 220 hours. So 220 days. In these 220 days, they are productive 6.5 hours. That means each employee works 1,430 hours. How many of them do we have? We have 7 of them. So now that means the available one, it is 10,010 hours that are available. We have 240 days, of which 20 days of this 240 is leave time. I'm not sure if I did write that one. Yes, 20 working days is compulsory annual leave. So now we have to say out of the 240 minus 20, meaning only 220 times this 220 by 6.5. Because each employee per day works 6.5 productively testing, meaning each employee works 1,450 for the whole 220 days. Then we multiply this by 7 employees. then this will be 10,000. By the way, let me say divide by 7. The 1,450 is for the whole year, not 1 day for one employee, because 1 day an employee is productive for 6.5. For 120 days, that will be 1,430. For all 7 of them, we get 10,010 hours. So we can see that there is a shortage. Minus 311, 00, that means we have 1,090, which is a shortfall. The minute there's a shortfall, we need to do the limiting factor, remember? Now, limiting factor, we don't have to be stressing our time. We can just start with the contribution. We already have the contribution that we calculated above. We will not be wasting time. 2,810 something. We did calculate the contribution. We will not be repeating that again. Contribution 2,810, 2,810, 36, 2,284, and 1,496. 2,836. Then after we have 2,210, 84, 2,284. Another one is 1,495. Just verify that one. 1,495. So from that, we know this is per mobile, this is per tablet, this is per watches. Then we divide this by limiting factor per unit. Limiting factor per unit. Our limiting factor per unit, remember our limiting factor, it is hours. So now we need to divide this by the limiting factor. So in this case, we know that we have 15 minutes. Here we have 30 minutes. Here we have 12 minutes that are required. It doesn't matter which approach you take. It doesn't matter which approach. You can use the minutes, but I prefer to use the time which is equivalent to per unit, because it is 0.25 and this is 0.2. Let me just verify. This is 0.5. This is 0.5, which is half an hour. This is 0.2, which is 12 minutes. Either way you use, you still take the same decision. Let us say 2,836 divided by 15, you get 189, which will be in this case per minute, per 15 minutes. That will be in minutes. Then if you say 2,836 divided by 0.25, you get the bigger figure, which is 11,344. That is still not a problem. That will be still not a problem. Then 2,284 divided by 0.5, and this is the one I prefer so that I don't have the decimals. 4,568. Sometimes in another question I'll be using the minutes so that I'm just running away from the decimals. Using the equivalent hours is just suitable for this one. 4,495. But both alternatives are provided in the answer. In the solution, both alternatives are acceptable. 7,475. So this is contribution per limiting factor. Contribution per limiting factor. Then after we do the ranking, 11,000 will be ranked number 1. This will be number 3. This will be number 2. Then after we allocate this limited resources. Allocate this limited resources. Then we are allocating the available time. Remember, available time allocation. We are allocating the time that is available. Available time 10,010. Then we do the allocation to the first product, to PM PM requires 4,500 hours. PM was ranked number 1, remember? PM was ranked number 1, and PM requires 4,500 hours, and this is in hours. Be consistent in your calculation. So 10,000 and 10 minus 4,500, meaning we are going to produce all the units of the PM. 5,510 is the available time. It is the available time. Then we do the allocation now to the second product. Allocation to PW, because PW was ranked second. And how many hours are required for PW? 600 hours. So we take the 600 hours that they require to produce their 600 units, the 3,000 units. Then we say 600 hours are required to test the 3,000 units. Then let's see how much the remainder minus 600. The remainder is 4,910. The remainder is 4,910, and these are hours. Then this will be allocated or available and allocated to PM or PT. Allocation to PT per tablet. Then units to be produced. How many units now must be produced? Why do we need the units to be produced? Is because the available hours to test product PT number of units is 6,000, meaning they need 6,000 hours to test 12,000 units. But now that we don't have the 6,000, which is we only have 4,900, therefore how much can be tested, produced and tested out of the 4,910 hours? 4,910 hours is what is available, so we need to know how many can be produced. 0.5 is the equivalent time in hours. Divide by 0.5, that means they can only produce 9,820 units. They can only produce 9,820 units, not 12,000, because they are ranked last and the available time was less than the required testing time to produce and test 12,000 units. So now be careful of the fact that these are hours. Again, throughout these are hours. Since these are hours, you need to divide by your time, which is converted into hours. You can't divide by 30 minutes in this case. You must convert 30 minutes into equivalent hours, which is 30 divided by 60, so that you take your hours, divide by hours. So now in that case, you will get the number of units that must be produced, which is 9,820. Then now we do the optimum mix PM, PT, and PW. We are going to produce the whole of the 18,000. We'll only produce here 9,820, and we are going to produce the whole of the 3,000 in here. So this is the optimum production mix, as they required us to do so. They said we must do the optimum production mix, optimum number of units that can be available. So those are the units that can be available. Sometimes they will say the contribution optimum production mix, but they will have the word contribution. If they have the word contribution, so now what do? You take these units, you multiply them by the contribution. Remember, the contribution is the one that we have calculated previously. This is the contribution. So now you need to multiply that optimum mix with the contribution. Then you get to the contribution at the optimum production mix. But that was not part of the requirement of this question, so we leave this one as it is. Then we go to the last part, which is theory, before 2 hours hit. List 4 quantitative factors that PEARS would have to consider when when the decision to centralize all the testing functions at Johannesburg warehouse was made. Now they want to centralize everything so that the testing is done in one center of function, which is in Johannesburg warehouse. Now, what they should take into consideration that is non-financial. They need to look at the, number one, they need to look at the capacity, physical capacity of the warehouse to perform all the required testing function. Do they have enough capacity to test all these 3 different products in one area? That is first thing to consider. Second thing to consider are the logistical arrangements of transporting all the products to be tested in one central warehouse, considering the fact that others are produced in Polokwane, others in Cape Town, others in Nelspruit. So now, what about the logistical arrangement or transportation in between? Will that be efficient? Then that is the second point to look at. The third point that they should look at, it is point number 3. It is the safety consideration regarding the transport and safekeeping of the products at the warehouse in Johannesburg. Now they look at the safety of transporting these products from these 3 different production plants and into Johannesburg, and their safety in the warehouse of testing in Johannesburg. That is the third point, the safety consideration regarding transportation and the safety of these products at the warehouse in Johannesburg. So safety in transporting and safety in the warehouse where they'll be doing the testing. Then the other point that you can also take into account, it is bullet point number 4 that you must look at, which is non-financial. Turnaround time regarding delivery or delivering the products to the retail outlets of the testing plant. Now we need to look at the turnaround time. Now we have 20 outlets around across the country. Now, what about the turnaround time to delivering to these different outlets from one central warehouse that is located in Johannesburg? Will that be possible or not? If not, then we need to change the decision to centralize the testing. At the same time, we also need to look at the lead time, considering the logistical arrangement. We need to look at the lead time. The lead time is the time it takes from ordering to delivering the product. At the same time, we need to look at the regional labor unions with respect to moving the testing functions to Johannesburg after manufacturing them at a different place. So those are just randomly few of them that I wanted to list for you that you must take into consideration. The last one that I would love also to bring to your attention, because they said only 4, we don't need more than 4. The last one is the impact of the loss of testing function autonomy by the division, because the division, they had autonomy to test these products. Now they are losing that autonomy in that testing function where they used to test where they were producing. Now that autonomy will be centralized in one head office. Now the company also need to look at the loss of that. And thereafter, we also need to look at the inventory movement control and safety. Now this inventory will be moving these 3 different production plants into one central place. Now the inventory movement control and safety thereof must also be taken into account. The safety of moving this inventory from one place and the control of that to this one central place, because previously it used to stay in one place, produced, tested, and distributed to the different retail stores around the country. But now they have to be produced here and delivered in one place for testing. Now we need to look at the inventory movement control and safety thereof. With that, guys, being said, thank you very much. I hope this was very insightful and contributing to your knowledge. Don't forget to subscribe to my YouTube channel. With that being said, let's meet when we hear each other. Thank you.